The important thing about Greg's latest results is not simply that sales and profits rose. It is that the company appears to have become more adaptable than last summer's peak Greg's narrative suggested, but the share price reaction may have run ahead of the underlying demand. First half sales rose 7.2% to about £1.1 billion, while pre-tax profit increased by roughly 20%. Greg's also opened 34 net new shops, taking its estate to 2,773. Its response to warmer weather was notably different this time. Iced drinks, salads, and a new chicken roll helped offset the traditional decline in demand for hot pastries during a heatwave. That changed the immediate interpretation. Last summer, hot weather damaged sales and profits, prompting questions over whether Greg's had reached saturation. This year, management showed that its menu can evolve with customer behavior. The business is no longer dependent on the sausage roll alone. It can respond to changing tastes, attract younger customers with products such as matcha drinks, and sell more food through its grocery range. But that is only half the story. Existing shop sales rose by 2.1%, helped partly by price increases, while much of the total growth came from opening more shops. Greg's operating profit benefited from cost control, easing inflation, and an 18% rise in grocery sales. That is good execution, but it is not the same as a powerful recovery in customer demand.
The market's enthusiasm was amplified by positioning. Greg's had become one of the UK's most shorted stocks, with around 12.5% of its shares reportedly out on loan. When results proved less disappointing than feared, short sellers had to buy shares back. That helps explain why the stock gained 16% in a single day and 21% across July. The rally was therefore partly a judgment on Greg's operations and partly a reversal of an excessively negative market position. The more cautious interpretation comes from RBC. It said food-to-go visits fell 1.9% in the first half, broadly matching an estimated 2% decline in Greg's like-for-like volumes. Greg's has already raised prices by about 4% this year, and further increases could weaken demand. The company has also benefited from around £11 million of expected cost savings, but RBC believes future savings will be harder to find. Food and packaging costs remain exposed, while only half of next year's expected electricity use is hedged. That leaves Greg's walking a narrow path. Customers are price-conscious, so passing every cost increase through to them could reduce visits and volumes. Absorbing those costs would protect demand but squeeze margins. New shops can keep sales rising, yet management has already reduced this year's opening target from 120 to between 100 and 110. The long-term ambition of more than 3,500 shops remains meaningful, but each new location must earn an adequate return rather than merely add to the headline sales number.
For holders, the results show genuine resilience, but they do not yet prove a return to strong like-for-like growth. For watchers, the question is whether Greg's can keep winning customers without relying on repeated price rises, short covering, or continual estate expansion. The useful checkpoints are the next updates on like-for-like volumes, margins, new shop returns, and grocery growth. Greg says there will be no further price rises this year, so the next results should provide a cleaner test of underlying demand. My current reading is that Greg's has disproved the idea that one hot summer can permanently damage the business. It has not yet disproved the concern that the mature estate is becoming harder to grow profitably. The share price rebound reflects a real improvement in the operating picture, but how much of it is durable depends on whether product innovation can keep volumes growing after the benefits of cost control and a short squeeze fade.